Is your home in an HOA a financial time bomb? It's not just condos anymore. If you bought a townhome or even a detached single-family house inside of a homeowners association here in the San Jose Metro, at the time, because it felt like the smart move, the low maintenance move, the no yard to mow, no fence to fix, someone else handling all of the landscape, I want you to stick with me for the next few minutes, because that same decision might be quietly costing you money every single month, and it might be holding your equity back in a way that you hadn't been able to notice. Hi, I'm Steve Moon, your San Jose Realtor. Welcome to my channel where we talk about San Jose Metro real estate, and I help you navigate the most meaningful financial transaction of your life and making sure that you don't leave any money on the table. So I made a video a while back called "Is Your San Jose Condo a Financial Time Bomb?" It's become the most watched video on this channel. And because a lot of condo owners realized that their HOA had problems that they didn't know existed. But here's what most people missed. This isn't just a condo problem. If you own a townhome or a small lot single-family home inside a planned HOA community, places like Whisman Station in Mountain View, Rivermark in Santa Clara, or Seven Springs in Cupertino, almost everything that I'm about to walk you through applies to you as well. So let's go through it properly. Who this affects, what actually is happening, why it happened in the first place, when it starts to matter, and how you figure out where you personally stand. So let's start with the who. This is a bigger group of people than most assume. It's not just condo owners anymore. Communities like Whisman Station, Rivermark, and Seven Springs were built during the wave of higher density master plan developments that hit Silicon Valley starting in the late 80s and running through the 2000s. And they were full of townhomes, small lot single family homes, and every one of them were wrapped inside of a homeowners association. If you bought into one of these communities, or you're thinking about buying into one right now, this video is about you. Not the condo buyer down the street, it's about you. Now, here's what's actually happening right now. The whole appeal of these communities back when they were being built was convenience. A small lot, sometimes barely a lot at all, just enough for a patio or a strip of side yard, paired with HOAs that mows, trims, and maintains the common areas and private roads so that you don't have to. For a lot of buyers, especially two-income households with busy schedules and no time for yard work, that sounded like a genuinely great trade. Turnkey, low maintenance, somebody else's problem. But here's what nobody told you at closing. That trade-off has a real financial cost over time, and it's showing up in 5 separate ways. Some of them are slow and quiet. Some of them are sudden and enormous. And let's go through all 5 of them one at a time, because together they add up to real money leaving your pocket. Number 1, and this is a big one, the lot itself. A traditional single-family home in the San Jose Metro comes with real land, a backyard that your kids can actually play in, room for a garden, space to eventually add an ADU, space that's actually yours with no HOA architectural committee telling you what you're allowed to do or not. Homes in an HOA-governed communities like Whisman Station, for instance, were designed to trade that land away in exchange for density, smaller footprint, shared common areas instead of a private yard. And that felt like a fair trade in year 1, but over 10, 15, 20 years, land is exactly what drives long-term appreciation in the Bay Area. And buyers' behavior has genuinely shifted, especially since 2020. Remote work, pandemic-era priorities, families wanting real outdoor space for the kids and pets, all of it has pushed demand towards traditional single-family homes with usable land and away from attached and small lot products. And here's a simple way to see it. Picture 2 similar homes, maybe 2 blocks apart in San Jose. One sits in a standard single-family lot with real backyard. The other sits in a planned HOA community on a lot so small, yard is really just a side patio. 10 years ago, those two might have appreciated close to the same rate. Today, the one with usable land is very likely to be out appreciating the one without it, year after year. We're not losing money outright in that scenario. We are now seeing a K-shaped demand curve where homes with backyards are rising fast, while homes with no lots are falling. You're losing the appreciation that you should have earned. And in Silicon Valley real estate, missed appreciation is real money, every bit as real as a check leaving your bank account. Let's talk number 2, HOA dues and special assessments. The same mechanics that I covered in the condo video, just that it's different with different sets of amenities attached to it now. Instead of aging plumbing risers and elevators, these houses and townhome HOAs are maintaining private streets, community pools, clubhouses, entry gates, retaining walls, and balconies related costs if they still have balcony, and landscaping across an entire development. All of that infrastructure is now 20, 30, and in some cases 40 years old. And just like with condos, a lot of these associations kept dues artificially low for decades to stay attractive to buyers, which means that reserve funds haven't kept pace with what repair costs actually cost today in California. And here's a simple example of how that situation plays out. Say a 200 home HOA community needs to repave its private streets and rebuild a retaining wall, and the total bill comes out to $3 million. If the reserve fund only has $300,000 sitting in it, that's a $2.7 million shortfall. Split that across 200 homes, that's an assessment of roughly $13,500 per household, often due within 60 days with little to no warning beforehand. That's not a hypothetical stress test, that's an exact math that's already played out in HOA communities all across California, and it's the same math waiting inside plenty of house and townhome associations right here in the San Jose metro area. And that's also why you are seeing so many homes inside of HOAs hitting the market right now. Number 3, the rules themselves. When you buy into one of these HOA communities, you're also buying into a set of CC&Rs, or covenants, conditions, and restrictions, which limit what you're allowed to do with the property that you actually own. Architectural reviews before you can change your exterior paint color, restrictions on renting the place out, limits on parking a second car or maybe a work van or a boat if you have one, rules about what you can build, whatever small yard that you have, if you have one at all. One of these restrictions is a limit on your ability to improve your own equity position. A single-family homeowner can add an ADU, expand the kitchen, put in a pool to add hundreds of thousands of dollars of value directly on their own timeline. In a lot inside one of these communities, you need approval first, and the answer is always no. Number 4, insurance, and this one has gotten measurably worse over the last 2 years. Just like a condo association, HOAs covering common areas and shared structures are getting hit by the same California insurance crisis that I described in the condo video. Carriers pulling back from the state, wildfire and earthquake exposure pushing premiums up 20 to 60% or more in some cases, associations getting forced into surplus market coverage because standard carriers won't write the policies anymore. And when the HOA's master insurance premium jumps, that cost gets passed straight to you through higher monthly dues. And on top of that, you're still carrying your own individual homeowner's policy on your individual unit or structure. So you're absorbing California's insurance inflation twice. Once directly through the HOA and once more directly through your own policy. And number 5, when it's time to sell, HOA-governed properties run into friction that single-family homeowners never have to deal with. Buyers, lenders now scrutinize HOA financials before approving a loan. So they're looking at reserve funding percentages, delinquency rate among homeowners, any pending litigation, and the ratio of owners to renters. And if the HOA doesn't look financially healthy on paper, financing can be delayed or denied outright, which means it'll shrink the buyer pool down to cash buyers and the most patient finance buyers only. So you'll also be paying for resale disclosure packages and HOA certification fees just to get to the closing table. And all of that adds time on the market and creates downward pressure on your price right at the exact moment that you're trying to capture whatever equity that you've built over the years. So why does this keep happening? And why wasn't any of this obvious back when you decided to buy? Because from a developer side, this model made complete sense. Smaller lots meant more units per acre, which meant more homes sold on the same parcel of expensive Silicon Valley land. And from the buyer side, back in the 80s and through the 2000s, low maintenance and turnkey was a genuine, legitimate selling point. Nobody was thinking that 30 years down the line, thinking about reserve funding formulas or California's insurance market or how buyers' taste would shift after a global pandemic. At the moment of purchase, the trade looked pretty positive. It's only now, with these communities aging into their 20s and 30s and 40s, that the bill for that original trade-off is actually coming due. And that brings us to when this actually matters for you, because the timing here isn't theoretical. It's happening right now, and for three reasons stacking on top of each other all at once. First, the infrastructure in communities like these is old enough, 20 plus years in most cases, that major repair cycles are hitting simultaneously at the exact same pattern that I laid out in the condo video. Second, the insurance market pressure that I just walked through is a current active problem today, not a future one. Premiums are moving right now, this year, and heaven help you if you are forced into the FAIR plan. And third, buyers' preferences has genuinely shifted since 2020 towards private outdoor space, which means the appreciation gap between your HOA home and a traditional single family with a yard is a live present day gap that is widening yearly and not a hypothetical one on a chart somewhere. All three of these pressures are compounding at the exact same time, which is exactly why this is worth addressing now instead of waiting 5 more years to see how things pan out. So how do you actually figure out where you should personally stand? Start by pulling out your HOA's most recent reserve study and annual budget and look specifically at the funding percentages and any planned or previously discussed special assessments. The same first steps that I tell condo buyers to take when they're looking for homes. Next, get some real comps. Look at how homes in your specific HOA community have appreciated over the past 5 through 10 years and compared to traditional single homes with usable lots in the same San Jose submarket down the block outside of the community. That single comparison tells you whether the appreciation gap that I described earlier is actually showing up in your own numbers or whether your community has been that rare exception. Then add up all of your true monthly costs of ownership, mortgage, HOA dues, your realistic share of any known and upcoming assessments, and your own insurance, and compare all of that honestly against what it would cost to own a traditional single-family home at today's prices and at today's rates. For a lot of homeowners and communities like Rivermark, that full, honest picture ends up being more expensive on a monthly basis and weaker on appreciation than it would look like from the outside surface. So here's where I land on all of this. If you've built up meaningful equity in your HOA townhome or small lot single family home, enough that you could realistically trade up into a traditional San Jose single family home with real land and do so without stretching yourself financially, that window is worth taking seriously right now, today, not next year. You're not just buying a yard when you're making that move. You're getting out from under rising dues, looming special assessments, restrictive CC&Rs, HOA insurance exposure, and a shrinking buyer pool at resale, and moving into a type of property that has historically appreciated the most in this market, decade after decade. Not everyone is in a position to make that move today, and that's completely fine. If you're not there yet, at minimum, go pull your reserve study this week and get a real number on what's coming. But if you do have the equity and the financial room to act, waiting rarely makes this any cheaper. The dues always go up, the assessments come due, and the insurance market isn't loosening up anytime soon in the California market. If you want to actually run your numbers, your specific HOA, your specific equity position, what a move into a traditional single-family home in San Jose would realistically look like for you, reach out to me directly and let's go through it together before you decide on what to do next. Hey, thanks for watching all the way through this, and I'll see you in my next video.